Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pashurtadis, and joining me is lead investment analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, the highlight next week will be on the FOMC meeting on Tuesday and Wednesday. It seems as though the highly contagious Delta variant is complicating matters even more during a time when Fed policymakers are already grappling with a tapering decision. What are we likely to hear next week, and how might the US dollar and Treasury yields be affected?
So Maria, although we're not expecting any changes from the Fed next week, there's a lot of anxiety around this meeting because we might get more decisive signals around tapering. So it's not clear to what extent they will hold tapering talks, but we're certainly expecting that they will hold at least they will take those discussions somewhat further than they have done already, because up until now they were mainly thinking about tapering, and in July we could see the Fed actually starting to talk about tapering. But the question is, are we going to get any explicit signals about how soon are we going to get that decision on tapering? There's a lot of speculation that it could come at the August Jackson Hole Symposium, if not then at the latest at the September meeting. But this escalation of the Delta variant has added some uncertainty to the July meeting, because it could provide the doves within the FOMC an excuse to stay cautious and delay a decision on tapering until much later in the year. And the other point is that we might not get much details until the minutes are published. So that puts even more focus, of course, on Jerome Powell's press conference on Wednesday.
Okay, now we'll also get a barrage of data, including the advanced GDP report and PCE inflation. Is there anything specific we should be watching out for?
So it is indeed going to be a heavy data week. The GDP numbers will probably confirm that the US economy recouped all the lost output from the pandemic in the second quarter, and we might even get stronger consumption and personal income figures for June, which would be supportive of the dollar. But the main focus will be on PC inflation on Friday. Now, the month-on-month rate is expected to accelerate again by 0.7%. And if it were to come even stronger than that, we might see a few inflation jitters towards the end of the week, and which would probably spark some volatility in the bond markets. Overall, though, the dollar will mainly be swayed by what the Fed says about tapering, and of course on the broader risk sentiment in the markets.
Moving over to Australia and Canada now, policymakers there will also be scrutinizing inflation. What will that mean for the Australian and Canadian dollars, respectively?
So the inflation data will have significance, but may not necessarily change anything as far as the policy outlooks are concerned for the RBA and the Bank of Canada. Now, in Australia, CPI is expected to shoot up to 3.8% on a yearly basis, well above the RBA's upper target band of 3%. But given the recent lockdowns announced in Australia, which are bound to hurt the economy, the RBA is now even more likely to say that it will overlook temporary spikes in inflation, so we might not get a huge deal of reaction in the Australian dollar. Inflation in Canada, though, is already above 3%, but even there, it's unlikely how it would affect BOC policy, because in Canada, for the time being, the growth picture remains quite positive. We're also going to have monthly GDP prints, so even if we were to get stronger than expected numbers, it probably won't mean that the BOC will taper more quickly, because the global outlook has become more uncertain, and that itself is weighing on oil prices, which has also been dragging the loonie quite sharply down in recent sessions.
Okay, turning to the euro area now. We'll get flash estimates of July inflation and second quarter GDP, but how important will these be against the current backdrop where virus cases are rising in some member states? And what reaction might we see in euro dollar?
So the GDP data for the second quarter is expected to be very positive. The year-on-year rate, we could see an expansion of 13%, and we should also see inflation nudging back up to 2%. But as far as the ECB is concerned, it's got a long way to go before achieving its inflation criteria. We just had the ECB meeting in the past week, and Christine Lagarde made several references to the Delta variant, so we know that they are worried about it. The situation, though, isn't so bad in every Eurozone country, but the ECB looks set to remain cautious for the foreseeable future, especially following the completion of its strategy review, where policymakers decided to make their 2% inflation target symmetric. So Eurozone rates look set to stay in negative territory for even longer now, and this is likely weigh on euro dollar at least for the rest of this year.
Rafi, thanks so much. And thanks for joining us at XM.com.